We're going to take a quick look at impairment of goodwill. You can see this is the end of the previous question. So I've added in this section here. So the goodwill has been impaired by 20%. What does that mean? Well, at the end of each year, goodwill being an intangible asset, we check for impairment, and the directors of the parent company do an analysis and make an assessment of whether the value attributed to goodwill, here calculated to be 19,000, is actually representative of the value at the end of the following year. So let's see how we would do this. It's exactly the same format as previously. All we need to do is reduce the goodwill by the impaired amount. Goodwill appears twice, or in more than twice, in this balance sheet. Here as an asset, and it's here and here as the goodwill in the retained earnings for both the parent and the NCI. So it's included in these amounts. So to make sure the balance sheet still balances, we need to remove the goodwill impairment from both sides of the balance sheet. So let's do that now. We'll work out the impairment amount. Impairment. And this was how much? 20%. So let's just make a note of that. Impairment 20%. So this is going to be negative 20% times the goodwill, which means we're going to lose 3,800 from our goodwill amount, which means we will come to take one from the other, have that plus that, and the answer is 15,200 instead of 19,000. So we've impaired goodwill over the year by this amount. So let's build another parallel statement of profit and loss, and I'll put in the impaired figures here so we can see the difference. So instead of 19,000, we've got 15,200. This is going to be the same. I could just carry that over. So that gives us a total assets now of 15,200 plus 97, 11,2200. Okay, so we've dropped down. So that's the first half of the balance sheet, the asset side, and we need to make sure that this other half, the equity and liabilities, balances. So we're going to do that here. If you impair goodwill, it's going to be taken from retained earnings. So we can do a reduction here, less impairment. Quite on, less impairment. And what we're going to do is take the impairment, 3,800, and it's the parent's share of the impairment. Now the parent's share was 75%, so it's 75% of the impairment, which is 2,850 as their share of this 3,800. And that gives us another opportunity to just calculate that. Add these two together, plus that, plus the impairment. 64,650 instead of 67,500. So we've dropped slightly there. Put that figure in there. So the other impairment is going to be on the NCI side. So we need to take their proportion or portion of the impairment. And this is 25% plus the same impairment, 3,800 times by 0.25 is £950 off. Just cross cast to check we've got the numbers right. 2850 plus 950 is 3,850, so that's all looking good. Make a sum here, and we'll add up, let me just add these this way, plus 1150 plus the impairment is 10,550. So instead of 11,500, we're going to have 10,550. Move that into there. Add this up. So we'll sum this equity side. Now comes to 95,200 instead of 99,000. Liabilities is just the same. And if we add this to that, it will hopefully balance. Okay, so there we have it. The equity side and the liabilities side. Equities here, liabilities here. These balance, and we've therefore removed the impairment off the goodwill amount. This could be, say, a year following. Goodwill has dropped down, and we've pushed that impairment into onto well, it'll be in the income statement. So retained earnings has dropped for the parent, and the NCI retained earnings has dropped as well, and they've shared the impairment between them. So that is how you impair goodwill.